Okay, thank you. So let's call to order today's meeting of the Finance and Administration Committee meeting of the Silicon Valley Clean Energy of Wednesday, October 5th. Could you do a roll call for me, please?
Yes, I will start with you, Chair Rennie.
Here.
Director Givens.
Here.
Director Makachuk.
Present.
Director Abe-Koga.
Here.
Thank you. And I will note that currently we have Vice Chair Wei and Director Klein absent, but we do have a quorum.
Okay, and I don't think we have a meeting decorum video, correct? No video. Okay, got just getting too many organizations that are using those now. Okay, so first on our agenda is public comment on matters that are not listed on our agenda. I see no attendees, so I will open and close that for items not on the agenda and come to our consent calendar, which has only one item, which is the approve the minutes of August 1st. Would anybody like to make comments or changes to those or any concerns? Seeing no hands raised, would anybody like to make a motion for the consent calendar?
So moved.
Second.
Okay. I have Brian as a first and Liz as a second. Thank you. I'll do the call of the vote. Any comments on the minutes? Seeing no hands, I'll call the vote. Liz?
Yes.
Maybe I should start using last name. Director Makachuk?
Aye.
Director Abe-Koga?
Aye.
And the chair votes aye, so it passes. I guess you'd call that 402 with since two people are absent.
Yes, thank you.
Next on our agenda is our CEO update.
Thank you, Chair Rennie. Follow your lead and keep this crisp. You approved the budget at the last month's meeting, which was a big deal. And so today I don't have any actual items on the CEO report, but I'll just note that on the agenda, we have two meaty items that are very much aligned with our strategic plan. The first being our investment strategy and implementing that. And the Finance Committee has been involved in that for a while. And the second is the prepaid, both of which we've discussed in our strategic roadmap. So with that, I'm open to any general questions we have, Chair.
Are there any questions for CEO on CEO's update? Seeing none, it is an agenda item, so I'll open public comment. We do have an attendee. If the attendee would like to comment on the update, which was really not an update, please raise your virtual hand. I don't see hand raised, so I'll close public comment on that item. Close item 2 and move on to item 3, which is to recommend to the board approving an update of our investment policy. And I'm sure I'm turning this over to Director CFO Singh.
Yes, thank you, Chair. Good afternoon, committee members. First, I want to note that we have two guests with us. One is Monique from PFM Asset Management. Monique has been present at the last two committee meetings, and you'll notice the names sound familiar, PFM, but they're two separate entities. They used to be together. I believe sometime last year they separated. PFM Asset Management is part of US Bank now. And then we have PFM Financials Advisors, and we have Mike Berwanger, who you remember worked with us on our first prepay, and now he's working with us on our second prepay. That's the second agenda item. So I'll start with the update on the investment policy, and Andrea will go to the next slide. So this is an action item. What we're asking the committee to do is to recommend that the board adopt the revised investment policy that we included with the staff report, that we now fully engage PFM Asset Management to be our investment advisor. And I'll explain that in the next slide, what our existing arrangement is. And for the board to adopt two resolutions where we can join the California Asset Management Trust Fund and the local agency investment fund. And these are two very liquid investment pools that we'll talk about. In terms of the main areas of discussion today, we're going to review the objective and timeline very quickly. We'll go through the cash flow analysis we did to come up with the initial initial proposal that we're recommending for an investment strategy. And then I will turn it over to Monique, who's going to go into the detail and will build on the previous discussions we've had with the committee on the revisions to the investment policy, the choice of the overnight investment options, investment recommendations, and the controls that are in place with them acting on our behalf as in a fiduciary manner. We'll talk about next steps, and then we'll ask the committee to vote that the board adopt the recommended items. Okay, so we'll begin with next slide on the timeline. So our overall objective is obviously to improve returns. If you remember, since our beginning, our reserves were not that sizable, but now they are sizable, and for good reasons that we talked about in our previous meetings, that we need to hold adequate reserves for the type of risk we face in our commodity business. But with that being of sizable position now, we have the opportunity to significantly improve on our returns. So there's an urgency on this item now. And also the market, with the way the fixed income markets are performing right now, there are attractive returns right now that we can pursue in addition to what we do right now. And we're showing that if the type of returns we're seeing on the market right now, we could incrementally earn $4.5 million more than what we're doing right now. So that's a sizable dollars. So this effort, if you recall, we began this effort late last year. We hired management partners. It's a local agency, government agency consulting firm. We've had Jim Steele working with us, who, by the way, end of last month retired. And now we have Don Rhodes helping us. If you remember, Don Rhodes is very familiar with our organization. He was acting in my role as an interim CFO before I joined. So they are guiding us. They have a lot of municipal backgrounds, and they have managed funds using investment advisors in managing some of the cities that they have been CFO or finance directors of. So currently, as I said, all our funds are in the bank. We're earning very low returns, currently around 0.35% or 35 basis points. So we hired management partners to help with this process. They helped us issue an RFP late last year. We discussed the results of that RFP with this committee in December of last year, where we presented 2 firms, and with committee's concurrence, we proceeded to engage with PFM Asset Management, where Girish executed an agreement. The agreement is to basically do a preparatory work leading to board adoption of the investment policy, and board explicitly hiring them as an investment advisor. For the preparatory work, there's no fee paid to PFM Asset Management. Fee will only be paid for the assets under their management if the board approves the policy and directs us to engage in full scope of the contract with PFM Asset Management. So after last year, beginning of this year, we've been working with PFM Asset Management and management partners. We analyzed our cash flow liquidity needs, reviewed the investment policies. We went through analysis of various investment strategies, and PFM presented those to the committee in May as well as in August. And since the August meeting, we have further worked with PFM and management partners to refine that strategy. We've also developed a detailed cash flow analysis that I'll go through it at a high level, which we are using to recommend the amount of funds to invest with PFM Asset Management as our investment advisor. Okay, Andrea, we'll go to the next slide. So very briefly on the cash flow analysis, what we want to do is basically invest so that we can diversify, earn good returns, But at the same time, we don't want to be in a position that we invest so much money that when we need funds, we have to liquidate the portfolio or a portion of portfolio in an environment that's not ideal to do so. So that requires some modeling to say, well, how much cash should we invest? We've determined, I think we discussed this at the last meeting in August, that the duration we want to hold maturities to at most is up to 3 years, because for the most part, we're holding reserves because we want access to those funds in case we have some of those black swan risk events that we talked about before with the committee. So we model the cash inflows and outflows, and we looked at various under normal business conditions as well as under stress test conditions. These include like revenues drop significantly because market prices drop. Cost of energy procurement increases due to increases in energy prices, so we can have huge collateral calls from the California ISO. Extreme heat events like the one we experienced in September, where we had within 1 week, we had to post 23 million in collateral to the California ISO. So that speaks to the need for having healthy reserves and cash balances. And also to what happens if the market prices were to actually drop and we get calls for collateral from our counterparties, those who we have energy transactions with. So the bottom line, the bottom line of the analysis, and I'll go into a little bit in detail in the next couple of slides, but the results we're showing is that for normal operations, 25 million is sufficient for us to hold, but we want to hold another 30 million in highly liquid fund that we can access overnight. And that's the CAMP or the LAIF or other instruments that the bank may present to us. But we want to have that in a highly liquid fund, overnight fund. So for example, if we have the heat event that we experienced, we can tap into those funds. And as of right now, our cash balance, I should say, was around 165 million. So looking at 165 million, we decided that the remaining 110, we can invest in investment duration of up to 3-year maturity term. Okay, we'll go to the next slide. So little highlights of the scenario analysis. We looked at P1, again, is the probability that energy prices drops to the 1 percentile level. That means there's only 1% chance that prices could be even lower than that based on the distribution and the volatility we observe in the market using Ascent Analytics model to build the distribution of prices. And then the P33 is at the 33rd percentile and 67th percentile, and P99 is there's only 1% chance prices could be higher than the prices we model at P99. So we looked at cash flows under each of those, and they all have different implications. P99 is where we could have increased collateral calls from CAISO. P1 is over time, this is the most stressful one, if you remember the stress test analysis, is where prices drop. And because we have hedges in place, we don't have commensurate drop in our energy procurement costs, but our revenues, because of the way we peg our rates to PG&E and the way PCIA behaves, our revenues drop significantly. So that would be a very catastrophic event that can happen. And we've seen these scenarios happen in the past in relatively short periods of time. So we modeled those scenarios, these price scenarios starting in January 1 of 2023. We layered in a heat wave event, and we looked at cash inflows and outflows and to see how much could we invest where we don't have to, on a reasonable scenario, tap into breaking our investment or tapping into the investment portfolio and incurring a potential mark-to-market loss. So we'll go to the next slide. So if we want to be the most conservative, then what we would look at, what we call the minimum cash envelope, is under all the scenarios that I presented in the previous slide, we look at the minimum amount we can invest, where we can hold 25 million in cash, 30 million in a highly liquid fund. That would say that we have only 5 million invest over a 3-year maturity, and an additional 94 million over a 2-year maturity term. And so this would be the most extreme scenario. Again, this and the constraint, the binding constraint comes from the scenario P1 here, where again, energy prices collapse and we have significant drop in our revenues. And to maintain that 1% customer discount rate to be competitive, we're tapping into the reserves. And so if we're saying under this scenario, we don't want to, if this scenario happens and we don't want to tap into breaking our investment, then invest only 5 million out to 3-year horizon and 94 with a 2-year maturity term. Okay, so we'll go to the next slide. So that what I presented in the previous slide is the most extreme case. For cash investment purposes, we don't recommend that we use the most extreme case, because if the extreme case happens, the consequence of tapping into an investment portfolio is not that severe. It's not like we're going to run out. If we don't have reserves, if we don't have the funds, we can run out of business. But we have the investments. We can always we can always sell the securities. We can sell them within a day, right? These are very liquid instruments that Monique is going to talk about, and we can access them. And there's a chance that if we do an untimely sale because we need the funds, remember the consequence at this time we're dealing with are much severe than a potential mark-to-market loss. We've got a big crisis on the commodity side that's happening. So this would be a small on the radar screen event, but we're saying there's a chance for mark-to-market loss, but there may not be. We could actually have a gain. And PFM Asset Management has done some analysis to show that actually when energy prices collapse, which is when we're likely to have the worst scenario occur to us, the fixed income securities tend to perform well. In other words, there's a negative correlation between fixed income security returns and energy prices. And the reasoning for that is when energy prices collapse, it tends to happen when the economy is in recession, or like happened during the Great Recession in 2008, during the financial crisis. When the economy is not doing well, then usually what happens is central banks will start lowering the interest rates. And at that point, the fixed income securities, the bond prices will increase, and they will. So while there is a chance for a loss, but there's more chance we may actually be at a gain. So we don't recommend using the most extreme case, but a more moderate case where we're looking at P33 scenario. And that's how we came up with the recommendation initially. Initial recommendation is 110, and we will refine this. As you can see, our cash positions will increase, and you can see our ramp up to beginning of 2023, and we're modeling that ramp up because of improved revenue conditions that we're expecting in the coming months. We need that ramp up for the potential polar requirement. If you remember, provider of last resort that we discussed with at the stress test analysis, where we could be posting significant amount of money to PG&E if the PUC accepts some of the proposals for the financial security requirement that could go up currently at 147,000 on the worst case. If it were to adopt PG&Es, it could be as high as like 70 million that we've talked about. So we're modeling those cash needs as well. Okay. Any questions on the analysis? I think next slide, I'm going to turn it over to Andre. If you go to the next slide, I think that's when I turn it over to Monique to go over the investment strategy and the revisions to the investment policy. But any questions on the cash flow analysis?
Doesn't look like it. I guess we can keep going.
Okay, Monique.
Great. Thank you, CFO Singh. Good afternoon, everyone. It's a pleasure to once again present to this group today. I am going to share some slides and walk through, as CFO Singh stated, where we are and what our recommendations are for the implementation of the policy changes we're recommending. Just an outline of where I'm going to go. I'm going to review our recommendations that we spoke about in the May and August meeting. The goal is to have your concurrence on these policy recommendations to move for full board approval. We're going to review our recommendations after months of discussion with staff and the your consultant for the maturity structure of the portfolio and the benchmark. And we're actually going to get into some of that portfolio structure itself. So with that said, I did want to briefly review what we did with staff regarding the investment policy and your consultants. We performed a review of the investment policy and provided a series of recommendations. Our recommendations were meant to do a few things. One, incorporate best practices into the investment policy, make sure that it represents the best practices, such as those written by the California Municipal Treasurers Association and the Association of Public Treasurers for the United States and Canada. And we wanted to expand the list of authorized investments to allow for a number of the investment types permitted by California government code within a reason to ensure that we help mitigate risk. The current investment policy as approved only allows bank deposits and overnight deposits. We have previously provided that block-lined version of the investment policy. That's included in your packet. And we did add an additional edit based on our last discussion with this committee to ensure that there were no conflicts of interest with regard to municipal debt issued by any of the participant agencies. So that was an additional change that we added, and I'll talk about that as we go along. Now, this discussion will focus on the expanded list of authorized investments for SVCE. And to really set the context for this expanded list, I always find it helpful to provide a visual representation of what the investment universe is and what is actually allowed by the California government code, which governs the investment vehicles which are authorized for public agencies like yourselves. As you can see here, there are four primary categories of investments in the universe. There is alternative investments, and that's commodities, real estate, hedge funds, not allowed by the California government code. There are equities, that would be your stock investments, both domestic and international, also not allowed by the California government code for public agencies. Then there's your what we call broader fixed income. Think emerging market debt, convertible equity, bonds to equity debt, high yield bonds, junk bonds. Though that type of debt is not allowed either by the California government code for public agencies. Instead, what the California government code allows is for conventional short-term fixed income securities, the majority of which has a maximum maturity of 5 years. And we're talking about US Treasury investments, federal agencies, municipal securities, commercial paper, certificates of deposit, supranational bonds, which is, for example, bonds issued by World Bank, International Bank of Reconstruction and Development. So very high quality, short duration, fixed income debt is really what we're talking about as your allowable investment universe. Now, when we looked at SVCE's investment policy, the policy really only allows for overnight bank deposits and state pool investments. We recommend that you expand your policy to include some of these investment types authorized by the California government code in 3 different categories. 1, overnight investments. 2, government securities, and 3, some credit instruments. Now, with the overnight investment types, currently SVCE is limited to, again, deposits at the bank, which, as CFO Singh mentioned, is currently, for the purposes of our analysis, earning around 35 basis points. We believe by expanding your overnight investments to include other types of money market funds and local government investment pools like CAMP, which we'll talk about, will allow you to diversify your liquidity options and your deposit options and to earn a more attractive rate of return in today's environment. And we have a recommendation which we'll go through. On the government side, we are recommending that you allow U.S. Treasury securities, federal agencies, municipal obligations, and supranational bonds. Now, when we look at munis and supras, we did add an issuer limitation on those sectors to provide for diversification. So the goal here is not to over invest in any particular one issuer, but to ensure diversification in these sectors, but allow you to have more options in your investment portfolio. You'll also notice that Supras are limited to 30% of the portfolio, which is consistent with California Government Code. Now, in terms of the credit instruments, we recommend adding commercial paper, negotiable certificates of deposit, certain asset-backed securities, and these would be, for example, leased-backed securities, some car notes, auto loans, receivables, also very high credit quality, and medium-term notes, which is shorthand in the California Government Code for corporate notes. Now, all of these investment types would be limited to 5 years and end. We add the same 5% per issuer limitation here to ensure appropriate diversification. We'll talk about our credit process as it relates to these securities later in the presentation.
Quick question.
Yes.
When you've got 5% per issuer, that's not 5% of the 30%. That's 5% of our entire portfolio.
That's correct. That's 5% of the entire portfolio.
Okay. And then obviously 30% of the portfolio those are maximums of the entire portfolio.
Correct.
Okay.
So where percentages are noted, that is of the entire portfolio. And we further, just to note, as far as our process is concerned at PFM Asset Management, when we apply these limits, we apply these limits to the amounts we have under management. And that ensures that we don't exceed any of these limitations if you have funds invested elsewhere. So we're not relying on a number that's outside of something we can see. We always want to ensure that we're in compliance with your policies and with the limits stated.
Thank you.
So I'm going to talk about some of the investment options that we're recommending for the assets that CFO Singh has identified as being targeted for investment. And the first pot of funds that we're going to talk about is that $30 million that is in that quasi-overnight, quasi-liquid investment bubble. We are recommending the California Asset Management Program. It is a type of local government investment pool. The reason we are recommending the California Asset Management Program is because it is an investment pool that is owned by a California public agency called the California Asset Management Program. This is actually a cash reserve portfolio, which goals is to preserve principal and provide liquidity at a stable net asset value of $1. This type of investment pool used to be called a money market fund-like product, in that it provides the liquidity of a money market fund. Some statistics about CAMP. It has a weighted average maturity of 26 days. So again, very much like a money market pool, it's short duration. The 7-day yield was 2.61%. That was the yield as of September 23rd. So that's sort of our target analysis state. So 261 for overnight investments compared to 35 basis points. This provides you with liquidity, but also gets you income that's more attractive. The pool is rated AAA by Standard & Poor's. It provides same-day liquidity by 11 a.m. It allows staff at your organization to wire funds in and out of the program online, unlimited. They can do that account management. It also provides the ability to open multiple sub-accounts, so it's a very flexible program. Because it is like a money market program, that 261 is the net yield on the program, and it also provides specialized services for bond proceeds. And I know you all are talking about a prepaid later in your agenda. So this is an attractive option for that quasi liquidity pool that CFO Singh was talking about. It will allow the organization to have flexibility, not necessarily be tied to the program. Yes, Director Bekachek, did I say that correctly?
Yes, you did.
All right.
So any monies that are in this camp would be subject to the 8 basis points fee. Is that correct?
No, these funds are actually outside of that fee.
Okay.
So this is think of this as sort of a separate investment option for SVCE. We would not be charging any fees for funds that are going to this program under our investment advisory agreement.
So this is like essentially, if you've got unlimited transactions via wire, ACS, or ACH, or check, it's like a checking account.
It can be seen, a lot of clients who use CAMP for transactional liquidity. Some use it for reserve liquidity, just having sort of a liquid option to host funds in. But the benefit of CAMP is that there is that unlimited ability to move funds in or out, no minimum. And right now, the yield on CAMP is very attractive compared to the other pooled option, which we would tend to be speaking about, which is the state pool LAIF. And LAIF is a great option in some interest rate environments, just not the current rate environment, because LAIF is yielding about a 150 around there for the same type of liquidity. Now, when the interest rate environment changes, then we will have different recommendations for this pool. We may then say, let's take another look at the liquidity options, but right now CAMP is just a very attractive option for this type of liquidity.
Okay, thank you.
Any other questions about CAMP before I turn to the larger portfolio? Seeing none. So the longer portfolio, the assets that we were looking at to invest between 0 and 3 years, as CFO Singh spoke about, we spent a lot of time working with SVCE staff and also SVCE's consultant management partners to really evaluate various portfolio structures. We talked to staff about market benchmarks. We analyzed the risk and return characteristics of various indexes and sector allocations. I believe we had some of that discussion with you back in August. We also, as CFO Singh mentioned, worked on performing analysis of gas prices to ensure that in the worst case scenarios, we were comfortable with how a longer duration or more sensitive portfolio would behave in a stress scenario for SVCE. And as CFO Singh shared, we found that those returns were negatively correlated in cases where there's stress in the natural gas market. It's more likely, more probable that the bond portfolio would be in a positive market value. So the portfolio would likely be ahead of its market price versus behind. With that and all the information on the cash flow, we recommended the utilization of a 1 to 3 year US Treasury index to target return and look at a target maturity structure. And we thought that that was consistent with the cash flow analysis done by your team, and also our recommendation as far as where the value was on the yield curve. Now, when you combine that with our review of the investment policy, we put together this sample portfolio for you. A couple of things to highlight. One, we're working with the $110 million investment that CFO Singh spoke about. The duration, very close to average maturity of this longer portfolio is about 1.7 years. The net yield, so taking into account that approximate 8 basis point fee on this portfolio, is 4.33%. Now, in the upper right, we show the sector allocation of the portfolio, and this is our target sector allocation. And I use the word target because I want to assure you that when we start investing on SVCE's behalf, we're not going to immediately go and buy 25% corporates. You know, our goal is to enter the market and ensure that the risk return for the corporates and other investments that we purchase in the portfolio are appropriate. So we expect to, if we get the ability to move forward, we expect to purchase and move into this structure over the next few months and have it fully invested in this strategy, hopefully by calendar year end. The duration distribution, maturity distribution is shown on the right. You can see that we have about 60% of the portfolio in the 1 to 2 year area and 41% of the portfolio in the 2 to 3 year area. In terms of credit quality, the average credit quality for this portfolio is AA+. You can see the credit categories to your bottom left. You'll note about 57% of the portfolio is in that AA category. That includes your treasury and agency obligations. These are S&P ratings, and as you all may know, S&P has rated U.S. Treasuries at a AA+. I do want to take a moment and talk about our credit research process, because we do include an allocation to credit notes in the portfolio. PFM has a fairly strong approach to credit. We are owned, as Director Singh spoke about, by U.S. Bancorp Asset Management, and one of the goals of that partnership for us was really to enhance our credit resources. So we are leveraging both the combined resources of PFM Asset Management and US Bancorp Asset Management to perform credit analysis on all the credit, municipal, and asset-backed issuers we purchase on behalf of our client portfolios. The credit teams perform research on the individual issuers and prepare an approved issuer list. And so we only purchase approved issuers on our list. And we have both a taxable credit committee that focuses on the taxable corporate market and a public finance committee that does similar research for municipal bonds. In addition to that, we have a credit risk management committee, which oversees our credit policies, formulates risk management guidelines. For example, those issuer limitations that I spoke about at 5% per issuer, that changes depending on our comfort level with the issuers, and also uses the information received from the credit research group to manage issuers and provide any risk points. Director Gibbons, I see you have a hand up.
Yes, thank you so much. Kind of a series of mixed questions. So the 8 basis points that we talked about before doesn't change with the change to your merger with US Bancorp?
No, it does not. That's a great question, Director Gibbons. The 8 basis points is our fee for services. It captures all of the resources at PFM Asset Management, including the credit resources, all the work we do with your staff, all the ad hoc research that we do as well. That acquisition was completed last year in December. So we've been owned by US Bancorp Asset Management since the start of our engagement.
Okay, so I just, I'm always wary of banks' involvement in financial management. So I wasn't particularly picking up on that relationship prior to this conversation.
And I'll add, Director Gibbons, you know, in addition to the enhanced credit resources, I think one of the most advantageous outcomes of our partnership is our enhancement of our cybersecurity resources. You know, cybersecurity has been an area of particular focus for a number of criminals over the past few years. And because of the sensitive data we collect from our clients and the amount of assets that we manage for our clients, we thought it very important that we enhance and build up our cybersecurity resources. And our partnership with the bank, who is at the forefront of cybersecurity and tech firmware, has allowed us to really strengthen our controls, which is only going to be to your benefit.
Thank you for that. That's something that staff is focused on, and I'm sure we can get an update on as needed. The second part of my question is, some of the investment strategies you've recommended are tax-free and even perhaps double tax-free. Am I correct? And if so, how might the Silicon Valley Clean Energy take advantage of those?
That's a good question. We actually only purchase taxable bonds. There's no benefit to you as a public agency, quite frankly, for purchasing in the tax exempt market. So the municipal, any municipal allocation that you may see in this portfolio will be taxable municipal debt.
Okay, so, and we don't pay taxes on it?
I believe that is correct, yes.
Okay, so there's an advantage that we're getting a higher interest rate without paying taxes.
Correct.
Okay, thank you.
You're welcome. Are there any other questions? I have just a few more slides. I think I sort of led myself ahead of my cybersecurity slide, but I do want to assure you that cybersecurity is something that we take very seriously at PFM Asset Management, and we have a number of different controls in place to ensure that your information and your assets are protected. You know, our systems are proactively monitored 24/7. All of our websites have threat management gateways. We require an authorized user account for all of our internal controls. And we have a know your customer policy in place when we're establishing a new account. So we'll be going through that process with your staff to get on our systems. And that will allow us to ensure that there are authorizations to review for any client requests or edits that involve sensitive information, such as wire information, ACH instructions, anything that you provide to us with regard to the movement of your funds or money. Our goal, again, is to make sure that that information is protected. Also want you to know that sensitive information to SVCE is only available to certain PFM asset management employees. So there are instances, for example, where I, as your liaison, will be prohibited, for example, from providing investment instruction to your third-party custodian, to ensure that there's a lot of control around who has the authority at PFM to provide instruction and who at SVCE has the authority to provide instruction to PFM Asset Management. We also have a comprehensive reporting packet. So just want to confirm and highlight the fact that, you know, as we move forward with this implementation, you will continue to receive information from us. We will continue to meet with your staff at least quarterly to have discussions about the strategy, what we're implementing, to check in on the liquidity requirements and market conditions. We'll be providing monthly statements and performance reports, some of which we've included in the packet as an example. We also provide a number of educational and training materials, which a lot of our clients have found helpful as they onboard new staff and team members. And I believe in the August 5th presentation, you talked about some of the growth that your agency will be doing. So happy to supplement some of that in-person training. In terms of our next steps and what's coming up next for us as we continue on this project, of course, we're looking for the board to approve the investment policy changes and the continuation of our services so we can implement the strategy that we'll be talking about. PFM Asset Management, as your investment advisor, will never take control of your cash or investments. So we'll be working to help SVCE contract with a third party bank to provide custody services for those investments. And that is a best practice. We will be working once the investment policy is adopted to implement those rules on our compliance system and work to connect with your custodial bank. Just some, inside baseball on our compliance work, your policy rules. Not only do we implement them into our system, but we also test them to make sure that we're not doing anything to sort of break the rule. So we have a policy in place so that ensures that on the first day of investment, we're confident that everything is in place. Once we have the custodial bank set up and the policy rules in place, at that time, SVCE would transfer the funds to that custodial bank so that PFM can then provide investment instruction. On an ongoing basis, we'll be looking to invest those funds consistent with the strategy we spoke about today. And as I already mentioned, our goal is to invest those funds over the remainder of 2022. We'll continue to provide SVCE with status reports throughout the third quarter, as well as monthly and report at the end of the year and quarterly. And then, of course, we'll be able to meet with this committee and the board of directors as requested on an ongoing basis. So that is my last formal slide. Are there any additional questions for me about the strategy or anything I've laid out here today?
Any further questions? We've been kind of asking them as we went along. It doesn't look like there's any more questions.
Thank you.
Thank you for your presentation. Very thorough.
I think with that, we'll move to the slide with the committee vote.
So let me open up public comment. Would any member of the public wish to comment on this item? Please raise your virtual hand. Seeing no hands being raised, I'll close public comment and come back to our committee. I guess we need a motion to recommend this to the board if that is our desire.
Motion to approve.
Liz?
Second.
So I have a motion and a second. Any further discussion? Seeing none. I'm wondering if I can do the vote. Let's see. I'll continue to try calling for the vote. So I'll go ahead and call for the vote. Director Gibbons.
Aye.
Director Mekachek.
Aye.
Director Chin. Hung Wei.
Oh, aye.
Director Abe Koga.
Aye.
And the chair votes aye, so passes unanimously. I guess that's a 501 now vote, I think. We have one person absent.
Correct.
So with that, we can close this agenda item. I assume you don't need anything else from us on this agenda item and move on to our next agenda item. Let me get back to it.
Thanks, everybody. Very helpful. Appreciate.
Thank you.
Yeah, there was a lot of good stuff added. So now we're moving on to item number 4, which is to recommend to the board of directors to authorize the CEO to execute agreements with firms providing services, et cetera, et cetera.
Thank you, Chair. So I'm excited to bring back the prepaid discussion. And again, joining me with this discussion is Mike Berwenga from PFM Financial Advisors. So we'll go to the next slide, Andrea. So the purpose today is for the committee to recommend that the board authorize CEO to either approve or execute the agreements. And you notice I'm asking either approve or execute. And the reason for that is that CCCFA has technically, normally once CCCFA is established, they would execute these contracts, but it's still a new entity and the process and procedures are still being developed. So they've asked that we retain the flexibility that they execute, but in the event they're not able to, we'll have Grish execute. So we're presenting the recommendation as such. This is only for enabling agreements to hire the parties that are needed to execute the prepay. The terms of the transactional details will come later, and I'll talk about that. So what I plan for today is to go through the overview of the request. We'll talk about how we're leveraging the first prepay structure and the fees that we'll be paying, that the consultants and the council that we'll hire will get, physical impact, next steps. And I just want to remind that there's the committee that there's a lot of information in the appendix as well as in the staff report on the timeline of the first prepay, the details of the first prepay, how savings, the execution details, the cost breakdown, and also the overview of how the prepay structure works and background information. And if any of that would be useful to the committee, I can certainly go over those slides as well. So with that, we'll go to the next slide. So the request again today is to recommend to the board that board authorize execution of the agreements necessary to initiate the second prepay. We have 4 entities listed here, and with the exception of number 3, the other 3 we've worked with before, and I'll talk about why number 3 is different. We have PFM Financial Advisors as our financial advisor. We have our Disclosure and Issuers Council, and then a Bond and Tax Council, and Moody's Investor Service. Now, all of the fees, similar to our first prepay transactions, they're all contingent on the execution of the transaction. If the transaction doesn't occur, these entities will not get paid. There's a small minor detail that I have to include for the Chapman. I think they may get something like $30,000 that we're still nailing down the details of. But for the most part, they're contingent. Transaction happens, they get paid. The one exception is Moody's. If we initiate their services for credit rating, they will charge us. And for that reason, we're going to wait until there's a lot more certainty that the transaction will occur. That's when we will initiate rating agency services. And Morgan Stanley has agreed that if, due to no fault of us or Morgan Stanley, the transaction doesn't materialize and we did initiate a Moody's investor service, they will split the fee with us. In other words, market just isn't there, done everything we could, but we can't realize the savings that we need to realize, and the transaction is not going to occur. They will split the fee with us. Again, the details of the sizing of the bonds, the actual target savings that the board will designate will come later with the board. So at this point, the request is to approve these contracts so we can get engaged with these counterparties to initiate the second prepay.
Question for you. What are the comparable numbers on the fees from the first prepay?
Yeah, good question. And we can go to one of the slides, Andrea. We'll take that question right now. You can roll forward. Next one. Next one. Yeah. So because we're leveraging the second, the structure we established already with the first, we've asked that the parties give us a discount. So you can see that they are charging a lot less for the second prepay than they did for the first prepay. PFM, instead of $250, will charge us $175. The Disclosure and Issuers Council, instead of $310, will charge $200,000. ballot spar. So for our first prepaid transaction, we worked with ORIC as our bond and tax counsel. And they actually charged us $425,000. We're not able to use them for this prepay because there's a potential conflict. We are one of our, the board is committees aware of, we're in dispute with one of our power purchase agreements, and they are the counsel representing the other side. So because of that, we're not a potential conflict of interest. We're not able to use them. So we've got ballot spar that Mike reached out to other firms that provide this service, and they provided us, and there are not that many, few very good firms, and ballot spar being one of them with extensive experience in prepay. And they're willing to work with the structure that was established for the first prepay, and also at a reasonable price of $300 versus $425 we paid. And Moody's will, yeah.
So in the first prepay, we paid $250 plus $310, $315 plus $4.25. So
yeah,
that and then this is a very interesting slide, and so the second prepay is going to be, you know, what, 80% of it or so, 3/4, 80%.
3/4, yeah.
And then the first prepay, the size was, what was the principal amount?
The principal amount, again, the first prepay was, we did in partnership with SVCE.
Yeah.
Our share was about 48%. And the principal was around 1.2 billion. There's a slide in the appendix, Andre, if you can find it.
Oh, okay.
So, and this, we're thinking this prepay will be around 55 megawatts, close to around 10% of our load as the first prepay. And because commodity prices are a lot higher now than they were when we did this transaction, we're thinking it could be somewhere in the neighborhood of a principal amount of $725 million issuance.
Okay.
Okay. All right, we'll just go back. Sorry, Andrea, we'll go back to where we left off. Okay, yeah, so Moody's, again, we will initiate at a later time. Go to the next slide, please. So Morgan Stanley, we have asked that they keep their fee the same as the first prepay. Technically, this is not a contract we're going to execute right now. This is CCCFA at the time of issuance of the bond. This will be in the bond purchase agreement at the time the bonds are being issued. That's when we will execute this. The details of this would be in that bond purchase agreement. But we wanted to nail down their fee structure upfront. So they're going to charge same underwriting fee of $5 per bond. The example here I gave, again, the sizing of the bond will be decided later, but I gave an example of $1 billion that would amount to 5 million. But if we did like 725 million, it'd be about 3.6 million or so. Then the other ways they make money on the transaction is through a commodity fee of $1.10 per megawatt hour that they charge. And if we issue, similar to the first prepay, a floating debt, they will charge 4 basis points on the interest rate swap. So this is how they'll make their money. Again, the reminders is this minimal risk. All the fees that I've talked about are obviously contingent on the execution of the bonds, and the savings that we're gonna realize will be net of these costs. And we are not out of pocket any of this. These payments will be made from the bond proceeds. And the savings, let's say the board says, get us 8 to 10%, that will be net of these fees. And of course, the same structure as the first prepay is issued through CCFA as a conduit. It's non-recourse to us, non-recourse to them. they carry the credit rating and the backing of Morgan Stanley. Go to the next slide. So we want to leverage the structure we put in the first prepay. In the appendix, we lay out a detailed timeline of the 2+ years of effort that we put into that structure. We want to leverage that structure because it worked well for us. We're realizing the savings, and all that information is also summarized in the appendix. Since we have executed our first prepay with EBCE, MCE executed their prepay structure. Now East Bay, EBCE, they executed a second prepay structure, same approach that we're recommending here. They leveraged the structure, their first prepay structure that we worked on together. And there are several other CCAs that are pursuing prepay transactions right now.
That third bullet, pursuing their first prepaid transactions, is that correct?
Yeah, so there's Pioneer, there's a big CCA in the South, Clean Power Alliance, this 3CE in Monterey area. They're all pursuing their first prepaid transaction. MC's already done one. They did it shortly after we did ours. And EBC earlier this year executed their second prepay using the same approach we're recommending here.
What was the size of their second prepay?
Mike, do you?
It was about $1 billion on their own.
Wow.
Yeah, it's also worth noting that the fees that Amrit's quoting are consistent with that East Bay transaction, the second transaction. So they're about 30 to 40% lower than the first. Same for East Bay.
Were you involved in EBCE?
Correct. Yes.
Okay, was there any other question at this point? Okay, we'll go to the next slide, Andrea. Oh, we've covered this slide. Any questions, any additional questions on this slide? Okay.
My only comment is if you're going to use any of this for the board, I'd put the totals down here, and I'd include the 4 1/4 in the first column, so you kind of have an apples to apples, but you can show what the learning curve is for everyone.
Mm-hmm. Good point.
Brian, stop stealing all my comments.
Okay, we'll go to the next slide. So the fiscal impact, as I said, obviously the big driver of the savings, you remember, is the spread between taxable and tax-exempt debt rate. That's a source of the arbitrage. There is a source of the savings. So that depends on the market condition. And markets can open up, they can close. A lot depends on what's happening on the market. We think we can get target savings somewhere around 8 to 10%, close to 50, maybe 55 megawatt, which is about 10%, another 10, 11% of our load, where savings could be around $3 to $4 million per year. Again, there's minimal risk to us. Everything is contingent on the deal, and the bonds are not recourse to us. And we'll go to the next slide. So next steps, we will go to the board next week, asking for the authority to initiate the second prepay with the counterparties we've listed. Once that happens, we will work with CCCFA to execute these transactions. Because we're leveraging a lot of the first structure of the first prepay, a lot of the agreements will very much mirror what we have in place. So we can move fairly quickly on this deal. Our current schedule says we can bring the approval parameters of the transaction before the board in November. with, depending on the timing of the market, we could be ready to price the bonds in December. But after our board approves it in November, in October, they'll approve these contracts to initiate the prepay. If the timing works out as I've indicated, in November, they will approve the transactional details. Then the CCCFA board in their regular scheduled meeting on December 1st will have to approve it. They're the entity issuing the bonds. And then we could be in position to price the bonds if the market is there in December. I think that's the presentation. On the next slide, I'm asking the recommendation.
Okay, let me first open for public comment. Would any member of our public wish to comment on this item? Please raise their virtual hand. I don't see any hands raised, so I'll close public comment and come back to our committee for more questions or a motion. Director Gibbons.
I'm prepared to make a motion if there's no further comment.
Doesn't look like it. Go ahead.
Oh, I've got a question and
Your chance is up. You're done.
That's all right. Go ahead. Go ahead, Director Makachek.
this is a question for Michael. What happens with changing interest rates as interest rates increase? Does the amount of tax juice increase, and do we have a larger savings opportunity? Can you comment on that?
Sure. Yeah. Generally speaking, higher rates are better for prepaid transactions. You would expect to have a wider spread between your tax exempt rate and the counterparty's taxable discount rate. And that could manifest in both additional savings or a lengthier term to the transaction initially, right? Where your original transaction with East Bay was 10 years for the initial reset. You may be able to go further out as that sort of spread widens out further out the curve.
Okay. Thank you.
Sure.
I have no further questions, Director Gibbons.
All right, go ahead, Director Gibbons.
I move that the committee recommend to the board the staff recommendations for the financial administration of, let's see, I'll read it. Staff recommends that the Finance and Administration Committee recommends the board authorize the CEO to approve and execute the following contracts as listed, and the staff request that the committee recommend the board approve engagement of Morgan Stanley as the prepay supplier with the following fee structure.
All right, do I have a second for that? Brian, Director Makachek is the second. It looks like. Any further discussion? Don't see any hands. I'll call the question. Director Gibbons.
Aye.
Director Makachek.
Aye.
Director Hung Wei.
Aye.
Director Abe Koga.
Aye.
And the chair votes aye, so passes 501. Thank you, everybody. Any further comments on this item? Don't see any. That is our last regular item. Are there any general committee or staff remarks before we adjourn? Don't see any. Thank you, everybody. Then we'll see you at the board meeting next week. And we are adjourned.
Thank you, Albert and staff. Very nicely done.
Yep, thank you.